The Kenya Revenue Authority has published a raft of new regulations issued under the Income Tax Act, signaling the government's intent to cast a wider net over non-resident companies profiting from Kenya's fast-growing digital economy. If adopted, the regulations will replace the 2020 Digital Service Tax Framework with a more structured and far-reaching model. As Jimmy Mbogo now reports, multinational tech and digital service providers operating in Kenya should brace for a sweeping overhaul of the country's digital tax regime.
The transition from digital service tax to significant economic presence tax is on course. This follows the publication of proposed regulations aimed at outlining those eligible for the tax rate, and the penalties. The shift is set to bolster Kenya's tax revenue by capturing value from global digital flows that have so far been lightly taxed. However, according to tax experts, the rules are likely to increase compliance costs for firms and could discourage some smaller players from entering the Kenyan market.
There are challenges with this for a non-resident who doesn't have presence in Kenya, because you need to have a PIN, and for you to get a PIN, then you need to have a registered entity, or you need to get an exemption to get that PIN for you to be able to open a bank account. So that is an administrative burden for somebody who does not have any physical presence here in Kenya. So that's something that maybe the regulations can look at.
In the proposed regulation, the taxman is seeking to expand the definition of taxable digital service well beyond streaming and downloadable content to include artificial intelligence solution, a ride-hailing platform, a digital marketplace, e-learning, cloud hosting, fintech service, and even monetize user data, which will be brought under the tax net. The expansion will see global tech giants from streaming platforms like Netflix and Spotify to payment providers and AI firms, accounting to Kenya's tax authority in every transaction involving Kenyan users.
The regulations are providing clarity that has not been included in the Act in terms of what is the taxable services, giving a list of examples of the taxable services to be under the scope of SEP tax, the registration framework, the computation of the taxable income for SEP purposes. So it is a welcome move that the SEP regulations have come in.
According to the regulation, non-compliance will attract penalties and interest under the Tax Procedures Act, where the Commissioner can collect unpaid taxes from persons owing money to the taxpayer, customer, agent, banks, as well as hold such third parties personally liable if they fail to comply without reasonable cause. Jimmy Mbogo, Citizen TV, Nairobi.